Hey everyone, welcome back to Corporate Decoder, the place where we dissect dense corporate filings so you don't have to. Today, we're diving into Rayonier's latest quarterly report. It's got timber, real estate, and a surprising twist involving the sale of a whole chunk of their business. It's like a corporate yard sale, but with millions of dollars. It's before we get started. If you are getting value from our straight-to-the-point financial insights, make sure you subscribe. Join our Discord community linked in the description below where we discuss all things corporate and finance. This filing is actually a combined report from Rayonier Inc. and Rayonier LP because they operate as one business. Think of Rayonier Inc. as the parent company and Rayonier LP as the workhorse. The parent company doesn't really do anything except manage the partnership and issue stocks. The partnership owns all the assets and runs the actual business. We'll look at them both, starting with Rayonier Inc. Rayonier Inc. sales were about $83 million. That's a drop from last year, but operating income, which is the money left over after subtracting the costs of making their products, it was practically nothing, just $59,000. But wait, there's a twist. Rayonier Inc. had income from discontinued operations. This is where things get interesting. They sold off part of their business, specifically in New Zealand, and that sale added around $2.5 million to their books this quarter. Without that sale, their numbers would be even worse. Looking at the balance sheet, they have about $216 million in cash, which is quite a bit less than the end of last year. They issued a special dividend during the quarter. They paid out a lot of cash dividends, over $110 million. This likely explains why the cash holdings have dropped so much. Finally, let's check if there were some unusual items here, and there are. Under accumulated other comprehensive loss is about $14 million of losses, which means the company's total losses were even higher than what the profits portray aren't. So that was the overview of the parent company. Moving on to Rayonier LP, the operating partnership had the same amount in sales, but the net loss was over $3 million. Again, income was saved thanks to discontinued operations from the sale in New Zealand. The partnership basically exists for the benefit of the unitholders, which is like shareholders in a normal company. The partnership actually lost over $3 million. Looking at some assets, Timber and Timberlands is valued at around $2-3 billion. This is their core asset. We'll have to see how well it performs. Unlike the parent company, which issues the dividends, cash flow here is still mostly from operations, $27 million, lower than previously, but not bad. They received more money back on interest this year, good signs of smart asset management. Let's move on to the notes that hopefully will explain why sales are down. It says they are reclassifying numbers from last year to account for the sale of the New Zealand joint venture, also known as the yard sale from before. It's now listed as discontinued operations. The details about the non-controlling interest were rather dull. However, this part is worth mentioning. Income generated from the New Zealand entity had to be shared proportionally with the other stakeholders with that entity. Diving into revenue, a lot of it wasn't real. It was from payments that customers made in advance, also known as deferred revenue. To understand the true performance, we need to look at each segment. They will reconcile by mentioning it in adjusted earnings before income tax depreciation and amortization, better known as adjusted EBITDA. It is also worth mentioning they are including a loss of over $7 million from restructuring. This must be related to the sale in New Zealand. Next up is debt. Let's see the debt schedule. There isn't much change here. The long-term debt is pretty consistent. It is important to read about the obligations that aren't on the balance sheet. Rayonier has guarantees in letters of credit and surety bonds, a normal but important aspect of a company. Most of the assets can be readily valued as they have level 1 values, meaning that the price and value is easy to estimate. Reading through the notes, we can see they had to increase provisions for environmental and natural resource damage costs. This is for Port Gamble. The amount has increased since the end of last year. This isn't too big of a deal, but good to note as it signals more regulations are having an impact. Wait, almost done. Let's check other information for any surprises. It mentions what the directors and officers did, which is that nobody adopted any trading arrangements. Good, there is no insider trading going on. Finally, the report is signed off by the CFO, which means we've covered everything. Tablamac, what do we make of Rayonier's situation? It's pretty clear that the sale of their New Zealand business is a big deal. It's giving them a cash injection, but also means they're losing a source of income. The core timber business seems to be struggling a bit with sales and prices down in some key areas. I would wait for further quarters to determine if it's a good sign or not. Not on the other hand, there is the real estate, but it's not enough to offset the timber issues. Overall, it feels like Rayonier is in a bit of a transition phase, which creates both risk and opportunity. What do you think? Should they focus on real estate? How can they grow core lumber and timber business? Drop your thoughts in the comments below. If this analysis was valuable, hitting that like button really helps, and subscribe for more deep dives. Don't forget to check out our Discord for more in-depth discussion. Link is in the description below. See you next time.